Have you noticed? These days, new ETFs are popping up everywhere. There are so many, you don't even know which ones to pick. AI, semiconductors, gold, space tech, even the pet economy has its own ETF. They all sound trendy, full of potential. By 2025, there are over 14,000 ETFs worldwide, with total assets surpassing $16 trillion. In the US, more than $550 billion flowed into ETFs in just the first half of this year, a new record. China launched over 160 new ETFs, and Asia's ETF market grew nearly 20%. But here's the real question. With so many ETFs, are they all worth investing in? What exactly do they track? How are they structured? And are there hidden risks you might not see right away? This video isn't here to say ETFs are bad, but to help you see more clearly. What should you look for before buying one? On the surface, more choice sounds like a win for investors. But more doesn't always mean better, and behind all those choices could be risks you're not seeing. What is an ETF, and how does it work? ETF stands for Exchange Traded Fund. It's a financial tool designed to track the performance of a specific asset or a basket of assets, like a stock index, gold, bonds, or even futures. Some ETFs hold real assets, like shares or gold. Others simulate those assets using futures or derivatives. But here's the catch: how an ETF is designed, what it tracks, and how it operates can directly affect your investment risk. When oil prices crashed in 2020, many oil ETFs tracked oil through futures contracts. They had to keep rolling over contracts, selling the old, buying the new, but because of a steep contango, where new contracts are more expensive than old ones, they kept losing money on each rollover. Even when oil prices rebounded, the ETF's value didn't recover, because the fund had already been drained through this slow bleed. In 2022, natural gas prices swung wildly due to the war in Ukraine, supply chain shocks, and the European energy crisis. The leveraged ETF BOIL, which resets daily, reflected these movements immediately. Even though natural gas didn't collapse over the full year, BOIL dropped over 70% in just a few months, all because of short-term extreme volatility. Many investors assumed, if gas goes up, this ETF must go up even more. But in reality, they lost big. Then there's XIV, the inverse volatility ETF, which bet every day that VIX wouldn't rise, in other words, that markets would stay calm. But on one night in February 2018, the market crashed and VIX spiked 115% in a single day. XIV was wiped out overnight, because the fund's rules said, if the asset value falls below a certain threshold, it automatically shuts down. Investors lost everything, not because of fraud, but because they didn't understand the design. So why are there so many ETFs now? Simple. ETF providers earn fees. The more niche and thematic ETFs they offer, the more attention and money they attract. As long as the story sounds exciting, someone will invest. But if you chase concepts without checking the structure, you're slowly taking on risk, without realizing it. Before you buy an ETF, ask 3 key questions. What is it tracking? Stocks, bonds, or futures? How is it tracking it? Physical holdings or simulated through contracts? Any hidden costs, leverage, rollover losses, or poor liquidity? ETFs aren't good or bad by nature. The real question is, do you understand how they work before you buy? They're tools, not guarantees. They're packaged, but not always safe. You're not just buying assets, you're buying into a risk structure and an investment logic. This channel is here to help you break down financial tools and investment ideas in a clear and logical way. We talk about economic trends, misunderstood products, and how to think critically about markets. If you find this kind of content helpful, subscribe, give it a like, and drop a comment to tell me what topics you want to explore next.